Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome. We have a massive episode today. We're going to start with the collapse of Bonza. We're then looking at some of the learnings coming out of the earnings season in the US and closing out with another Pimp My Portfolio with Adam Dawes. My name is Bryce, and to chat through it as always is my equity buddy Ren. How are you?
I'm good, Bryce. Very excited for this episode to pull back the curtains on what's going on here at Equity Mates. Very excited to see you again because you've been away for a week.
Yeah.
Getting tanned in the Whitsundays.
Getting my tan on. Lucky enough to spend a few nights up in the Whitsundays for my sister's 30th.
Few nights. Feels like it's been a month.
Nah, 6 nights.
Happy 30th, Claire.
Yes, happy 30th, Claire. Spent lovely time with the family. Don't often get to spend a good chunk being, obviously mum and dad are still in Wagga, so it was lovely. Got to see the reef, Great Barrier Reef.
How's that going?
That's what they say in the papers. There's a fair bit of bleaching. But look, overall, I really enjoyed the experience. Saw some great fish, and there was still some colour in parts. So I think it's actually been on my bucket list, something to do before it was just completely annihilated. So yeah, I got it done.
That's sad.
I know.
Anyway, let's get into it, because while you've been gone, plenty of news has been happening.
News and markets.
Now, Bryce, you mentioned Bonza at the top, but before we get into that, probably the biggest news in financial markets at the moment is US interest rates. The Fed met last week and they have agreed they're not going to raise rates.
Holding rates steady.
Yes.
They do admit, though, that inflation is a little bit higher than they thought it would be at this point in time.
Yeah, it's like mixed news. So they said it's stubbornly high. It's not going down as fast as they want. They're going to hold rates steady. But Jerome Powell did come out and say he still thinks the next move is down, just not as soon as he thought it would be.
This guy's a political mastermind.
Do you reckon?
Yeah. I reckon. I think he's just saying the right things. He's very calculated.
I think we need to this is going to get me cancelled, but if they orchestrate a soft landing here, we need to give him some credit.
I think he already deserves credit, though.
Okay.
I think he's done an incredible job. If you look at where they are, we know this last mile is very difficult. Yeah. Very difficult. But he went pretty hard pretty early.
Yeah, like he's done the right things.
Yeah, absolutely.
Yeah. Now, it's important, when I was reading about this morning, the words from our JP Morgan Asset Management quarterly briefing were ringing in my ears, which was no one's going to cut before the US cuts, because if the US are holding or raising and other central banks are cutting, what that's going to do to that country's currency is just not really palatable. So JP Morgan Asset Management's view was no one cuts before the US cuts, and it's just like, as Australians, if they're right, we should keep that in mind and temper our expectations accordingly.
Well, Ren, all eyes will be on the RBA tomorrow when they meet to discuss interest rates.
Yeah.
So
head over to our Instagram. We'll certainly do something when the RBA announce.
Absolutely.
But the biggest business news story back here in Australia has been Bonza. The Australian airline has collapsed.
It's quite timely as well. When we flew into Proserpine, which is the local airport up there, it was packed with Bonza planes, and I'd never flown Bonza, and I even went searching flights between the routes that we generally take, Sydney to Melbourne or whatever. They don't do that route, I don't think. Yeah,
they also aren't. So let's start at the beginning, because even in what you just said there's a couple of unique aspects of their business model that didn't quite work. So started operations on the 31st of January 2023. It folded at the end of April 2024. So it lasted 15 months.
And this is a low-cost airline, by the way.
Yes, Bonza Airlines, low-cost airlines.
For Australia. That's their tagline.
But the two things that what you just said there flagged. First of all, they weren't flying in and out of the major cities. They were trying to fly regional routes, underutilized and unserved routes between regional and domestic cities through a point-to-point network model similar to that of Ryanair in Europe. So that's the first aspect of their business that ultimately didn't work. Australia isn't Europe, and it turns out Wagga to Gold Coast isn't Manchester to Milan.
Yeah. This is something I was thinking about when it was on the news. It's just like, did they not model this?
Well, I'm sure they did. I think the investors behind it, I read about them a while ago, and this is from memory, so it could be wrong, but I think they're like a Miami firm, but they backed a low-cost airline who did something similar in Canada, and it actually kind of worked over there.
Right.
So they thought they could pick it up and do it down here.
At least put in Sydney to Melbourne. At least.
Well, as we shared on our Instagram maybe a week ago, most valuable airline route, Sydney to Melbourne.
Exactly. Throw it in there. Maybe they didn't get the airport spots because we know the challenges the challenges that Qantas pose with Qantas, Jetstar, Virgin, like it's ultra competitive, high cost.
High cost, yeah.
So they probably need to wait for Badgerys Creek to open here in Sydney, but too little, too late.
Yeah. Now, so that's the first aspect where they were serving. The second aspect is you weren't going to find their flights on any Google Flights or Momondo or any flight matrix. No, you weren't, because you had to download their app and search for flights directly.
This is something I was saying when we landed, and I said to Harriet, my wife, I said, I've never seen them pop up on a flight aggregator.
Yeah.
It's because you had to download the app.
Yeah. They specifically weren't aggregated. That's what I'm telling you. Yeah. That was part of their business model. So I did download the app. Well, because I actually thought they were flying to regional centres. I thought they were doing a Rex. So it was like they would fly Sydney to Parkes. And so, if I was going to Forbes, then I could fly to Parkes. But then I realised when I downloaded the app and searched, it was not. It was,
it's like Parkes to Wagga.
Yeah, exactly. Yeah.
But they didn't go to Wagga.
Did they not go to Wagga?
No.
Oh.
Couldn't get to Wagga. It was the other part of the model was it was highly concentrated on Queensland.
Okay.
Yeah, very 12 or 13 stops in Queensland or something like that. And then missed pretty other significant regional areas in Australia.
I mean, I'm sure they modelled that. Southeast Queensland, growth area.
Wagga to Sydney, get it done, honestly.
Anyway, so this has just reminded me that airlines are a terrible business. And here's my big call. I will never invest in an airline in my life.
Oh, Warren Buffett over here.
No, Warren Buffett did invest in airlines.
He said he wasn't.
Yeah, I pulled out a couple of Buffett quotes about investing in airlines. This is from his 2007 letter. Indeed, if a far-sighted capitalist had been present at Kitty Hawk, he would have done his successors a huge favour by shooting Orville down. So that's the Orville Wright, when he first flew.
Yeah.
And then another Buffett quote from another letter. Investors have poured their money into airlines and airline manufacturers for 100 years with terrible results. It's been a death trap for investors.
I think it's also a shame, or potentially an indication of the... I don't know if competitiveness is the right word, but the fact that we can't get decent airline competition in Australia, I think, is a bit of a problem as well. But these airlines should be able to survive. But
well, no, part of the reason is because it is the most difficult industry in the world because you're competing with government subsidised.
Yeah, that's what I mean.
It's an irrational industry.
Yeah.
But Qantas, even one of the best airlines in the world, Australia's darling, Australia's protected darling, in the last 20 years, what do you reckon its share price has done?
It's flat.
No, it's up 50%.
Okay.
Yeah. And, it's paid maybe a dividend or two over that time, but not a heap of dividends coming from Qantas. I will never invest in an airline.
Yeah.
Hold me to that.
Okay. Deal.
Now, Bryce, the other big bucket of news that you've been missing while you've been on your holiday is earnings season in the United States is in full swing.
Full swing. We've got Q1 results coming out, so we're going to look at 3 key lessons.
Now, we haven't really had it in Australia because most companies report half yearly. We've had some quarterly results, but really the focus of this is what are we learning out of the US? And learning number 1, inflation has not gone away.
No.
I mean, not surprising given how we started this show talking about interest rates and all of that. But here's just some of the company highlights that sort of point to it. And I guess some of the contributing factors. So UPS, the delivery company, called out rising gas prices, and they've brought back fuel surcharges for deliveries. And that oil price story is going to be an important one for inflation with ongoing conflict in the Middle East.
Big time.
But that UPS called it out. PepsiCo reported that inflation is still all throughout their pipeline. Chipotle reported a wage increase and higher tech costs to support new restaurant software. The wage story is going to be an important story in Australia and in the US. Ford reported higher than expected costs in their EV division, meaning they lost more money than they thought they would in that space. They thought they were going to lose money. They lost more money. JB Hunt, a company that isn't as well known, but an important one for this story, a trucking company, had this to say about the economic backdrop. We continue to face inflationary cost pressures despite also facing deflationary pricing pressures.
That's tough.
That's tough.
That is very tough. Yeah. So we'll have to keep an eye on this one.
It's going to take time, I think, is the story. Learning number 2.
Yeah.
The smaller tech names are back.
How small?
Still massive, but not the giant Magnificent Seven.
No.
These are the tech names that had a massive run up in 2021 and then got smashed in 2022 and 2023, and they were doing layoffs. Their share prices were falling 80 or 90%. People were wondering if there was going to be bankruptcies. To their credit, there weren't a lot of bankruptcies. Also, to their credit, it seems like a lot of them doubled down on what worked and cut a lot of fat around things that didn't work.
Yeah.
The classic example for me is Spotify spent about $2 billion on podcasts and they just said, this is a losing bet, cut that, refocus on what works. So 2 examples that illustrate this, but it is a much broader trend in a lot of these names. Honestly, side note, we're going to look back at like 2022 and kick ourselves for not buying more of Shopify, Snap, Netflix, Spotify, like all those smaller tech names. Separate conversation. Maybe let's do a segment on that. The smaller tech names that we wish we'd bought 2 years ago.
How depressing. I mean, even Tesla. Yeah, I saw something. Yeah, Netflix has more than doubled.
Yeah, okay. Anyway, 2 examples that I want to bring from this reporting season. First of all, Snap. Snapchat always outperformed.
You love
People
Snap.
always wonder who uses Snapchat anymore.
You do.
Well, let me tell you who uses Snapchat. 422 million people daily. That is their daily active users number, up 10% from a year ago.
Pretty phenomenal. But this is one of those ones that I think always comes out and surprises. But their stock price hasn't done a lot since 2022.
No, but if you look at like the last 6 months, it's done well.
Yeah, but so what? So is every company in the S&P 500.
Not every company.
Very close
not Boeing,
to it.
Not Tesla. Anyway, let me tell you more about Snap. Quarterly revenue up 20% from a year ago, up to just over $1 billion. Still not profitable, but some impressive numbers. Spotify was another one I mentioned earlier. How about these set of numbers? Monthly active users up 19% from a year ago to 615 million. Paid subscribers up 14% to 239 million. Revenue up 20% and the highest ever quarterly profit. Spotify focused on what works and they're doing well.
The story with a lot of these, and it'll continue to play out over the next couple of weeks, is these tech companies that have just laid off thousands and thousands of people. It's starting to pay dividends because their cost lines are now so far reduced. Yeah. Anyway.
Well, speaking of paying dividends, let me get to learning number 3, which is AI may be expensive, but Google can still pay a dividend.
Yeah, first dividend ever.
Yes.
Yeah.
So all of the big tech players announced big increases in CapEx spending, like capital spending, and it's all because of AI. Meta, they flagged a $3 billion annualized increase in spending because of AI, so that'll get them to around $10 billion per quarter in costs. That's like total cost, not just AI, but the increase in costs is driven by AI. Microsoft said capital expenditures jumped 79% from a year earlier to around $14 billion for the quarter. And Alphabet, the owner of Google, said it spent $12 billion in the quarter just on capital expenditures, soaring 91% from a year earlier. So CapEx bills are rising because of AI, and that's because they need more computing power, they need more data centers. It's an expensive enterprise. But even with this increased AI spend, one of the biggest headlines from this earnings season is that Google is paying its first dividend, 20 cents a share. But don't worry, they also are doing a $70 billion stock buyback as well.
It's crazy. These tech companies continue to amaze me. I read recently that Microsoft are apparently exploring developing their own nuclear reactors.
Yeah, I know, because of the energy requirements.
Because they are going to require so much energy for their AI.
Yeah, crazy.
Now, that's a capital expenditure. Imagine doing the budgets for that and being like, guys, we need to factor in a nuclear reactor.
Yeah.
And
well, honestly, like
that is crazy.
You think it's crazy, and then you stop and you say, well, these companies are bigger than most countries.
Yeah.
And they've got energy needs bigger than most countries. And then it's like, yeah, okay, well, now it's starting, I guess, to make sense that they vertically integrate a lot of things in their supply chain when they think they can do it more efficiently. And if I was an American company looking at the US electricity grid, and a lot of electricity grids are struggling with this transition to net zero, you'd probably say we might be able to do this more efficiently.
Definitely. Well, to put that into context, in 2019, Microsoft planned to open 100 data centers over the next decade. They are now building more than 100 every year. And are increasing their number of data centers from 192 today to 800 in the next 4 years.
Jeez.
That is crazy.
So Microsoft experimented with an undersea data center because obviously one of the biggest challenges with data centers is keeping it cool because it's just like so many computers running, it gets hot. So the massive air conditioning bills. And so they were like, what if we put it under the water to keep it cool? And like the rate that we're building data centers, we might need to start doing that.
Yeah.
Probably not good for the reef.
We are in a crazy time at the moment. These companies are just,
what about,
so big.
What is freezing cold? Space.
Yes.
Space data centers.
Elon.
All right, before we go too deep down this rabbit hole,
anyway.
Let's pause here. Let's take a break. We'll keep you up to date with what's happening in earnings season on the podcast, through our email, and on Instagram. So make sure you're subscribed. All those links are in the show notes. We're going to take a quick break here, and on the other side, we're going to be joined by Adam Dawes for another edition of Pimp My Portfolio.
It is time for...
This is Pimp My Portfolio. Pimp My Portfolio.
That's right. It is Pimp My Portfolio, the time we bring in an expert and a community member to get their portfolio pimped. And it is our pleasure to welcome our expert to the studio, Adam Dawes.
Great to be here, guys.
And our Equity Mates community member, Richard. Richard, welcome to Equity Mates.
Hi, guys. How you doing?
We're very well. We're very excited for this one. So to kick things off, Ren, what does Richard's portfolio look like?
Yeah, so it looks like we've got a portfolio of ETFs here, a number of Vanguard ETFs, the Aussie Shares High Yield, Aussie Shares, Diversified Growth, Diversified High Growth. That fund is also held off market, the High Growth Index Fund, the Vanguard MSCI Index International, and then finally an iShares ETF, S&P 500 ETF. So there's 7 ETFs, and then there's one individual stock holding, and that's ResMed, which is just shy of 10% of the portfolio. So, Dawsey, what do you think?
Well, look, I think, Richard, you've got a good portfolio here, but we're going to give it a name of a double up. I think you're sort of doubling up on the ETFs that you've got in there. Did you just sort of choose these sort of at random, or are you sort of, there's some plan behind this?
It's just like, so as young, I watch a lot of like podcasts and a lot of recommendation on YouTube. So that's why I'm thinking that as I'm young, I should take risks. So that's why I start to purchase some of the ETF and see how it's go. But right now, as I go through my portfolio, I think it's kind of be overlapping like some of them. So that's why I'm saying.
It's definitely overlapping and just taking the two. So I really like Vanguard as an ETF provider. They have very low MERs, MER meaning management expense ratios. So they are some of the lowest in the market. So you're doing very well by keeping with the Vanguard theme there. But then also you've got, the Australian high shares yield as well as the Australian shares. Now, both of those ETFs will have BHP, Commonwealth Bank, Woolworths, and all of those. So you've sort of doubled up on those two. By buying two different ETFs, you're still doubling up on the individual stocks that are inside of that. So I think that's something that you need to look at. And then obviously the Vanguard diversified growth and the high growth side of things, that's obviously, you're wanting to grow the portfolio. So I think that's in the right space. That looks good. But over then again, you with the diversified growth, you're doubling up again in each individual sector. So you need to look at the portfolio, especially ETFs. You can go online and do ETF fact sheet, and you actually look at the fact sheet that the ETFs, so Vanguard, VAS, and look at the fact sheet, and it'll give you all of the holdings that you've got in there. And so what I'd recommend is that you print out or looking at on the screen of the different ETFs that you've got and seeing your double ups there, seeing how those weightings are going to be affected. And I think that's really, really important to start with. Really like ResMed, I think you'll do okay. I suspect you're in profit on ResMed, is that correct?
Yep.
Yeah, good. So keep that, so that's fine. And certainly the iShares S&P 500, you probably would have done quite well. How long have you held that one for?
I've been holding it probably around 4 or 5 months already.
Okay, so you've made some money. Yeah, that's been good. So that's been good for you. But I would definitely look at which one would you choose? I mean, I suspect that you're sort of quite young still. So the high growth, the Vanguard Diversified High Growth Fund is probably better for you because you've got time for it to grow. But also if we have a bit of a blip in the market, you've got time to make that back. And potentially, if you do look into the high growth side of things, the Vanguard, which is the VDHG, you look into that, it will then have subsectors or asset allocation. So, Ren, we were talking about it before. It's got 30% Aussie.
Yeah, about 30% Aussie, about then 40% global shares.
Yeah.
It's got a little allocation to small companies and emerging markets, and then some fixed income as well.
So that makes sense to me with a lower balance of a portfolio is to basically selling some of these other ones and just putting it into that high growth side of things. That will give you more money in one ETF, and that'll allow the ETF to grow over time. And I think that's probably better than having these sort of different shares all doubling up and overlaying. And then we like it to what's called the core versus satellite. You got to have the core portfolio, which could be the diversified high growth side of things. And then you can have some fun with some speculatives or some stuff on the outside if you're putting more money into the market on a regular basis.
Richard, you're at uni, right? You're very, you said you're young. That's right. You're at uni, and are you just putting a bit of money in each week or each fortnight? How are you approaching building the portfolio?
It is like 50% of my income will go toward ETF and fund. Fortnight and monthly is my currently investment right now. I got two brokers. One is Common Sense, and second thing is Vanguard. So the Vanguard would be fortnight, but Common Sense is gonna be like the monthly investment.
Nice.
I think, Richard, it looks like you're doing a lot of things right. Like you're starting young, you're investing 50% of your income, like that's great.
Yeah.
And you're investing regularly, fortnightly or monthly. So I think there's a lot of great things there with your personal finance habits. One thing that people often get tripped up on is they feel like they need a lot of different lines in their portfolio. And it makes sense because we always hear about needing diversification. But the great thing with these ETFs is that they are diversified themselves. So, you don't feel like you need 6 or 7 ETFs to be diversified. If you get some of these ETFs are diversified enough, and the one that Adam was talking about, VDHG, you've got global stocks, you've got diversification across asset classes. There's plenty of diversification built into that product. Yeah.
And Adam, correct me if I'm wrong, but it's more beneficial more often than not to get a reasonable, $5,000 to $10,000 position in VDHG than multiple little $500 positions all over the place.
And then having that regular contribution strategy that you're doing, Richard, is that when markets are up, you're continuing to contribute, and then when markets are down, you're continuing to contribute. So over the longer period, you get a better portfolio with better cost bases going forward. So you're doing it right. It's just that you've got these sort of mismatch of ETFs in there, and I think cleaning that up will do better for you in the long run.
Love it. Well, Richard, I hope Adam's been able to provide some general advice there for you that will help you clean up the portfolio and put you in a better position. But as Ren said, I think there's so many things that you're doing right. We look at ourselves when we were in our 20s. We definitely weren't doing this.
Putting 50% of our income away. 50% of our income
to definitely go into other things. So well done. And I hope you got something out of today's session.
Yep, definitely. To be honest, that's a good guy for me right now.
Awesome.
I watch a lot of ETF, a lot of YouTube videos because I don't know exactly what should I focus on right now.
Well, I think, as Adam was saying, there's nothing wrong with focusing on one of them that's in your portfolio at the moment, VDHG, but you're definitely on the right track. So it's all there in front of you.
Yeah. All the best with it, Richard. Good luck.
All right. Thank you for that.
This is Pimp My Portfolio. Pimp My Portfolio.
If you'd like to submit your portfolio just like Richard did, then head to equitymates.com/contact and there'll be a section for Pimp My Portfolio. And if you'd like to sit down with Adam Dawes, head to equitymates.com/advice and tick the Adam Dawes box and we'll make sure we connect him with you. But Adam, as always, absolute pleasure.
Yeah, thanks so much. It's great to be here, guys.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.